Hey everybody, good to be here today. My name is Brent Moore. It's time for Long Options. Today, I want to talk about using puts to try and help hedge your portfolio. Over the past few weeks, we talked about using leaps. That was last week. We talked about doing swing trades. We talked about sample plans for all these swing trades and then trend trades. And, if you are interested, you can always go back in the playlist just on the Trader Talk Schwab channel to see some of those past sessions if you like. If you're watching live, I can put that playlist right in the chat, which I'll do right now. And if you're not watching live, if you're watching on a recording, hey, I'm glad you're here. You can just go to that Trader Talks channel and watch there. I'm joined alongside Connie Hill, who's helping me on the chat as well. And everything I'm going through today, Connie knows inside and out. So as you have questions, feel free to type those in between Connie and myself. We'll do our best to help you out there. You can also follow us on X at Brentmore CS, at Connie Hill CS. So there we go. Let's go through the initial disclosures here, then we'll get into it. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not a recommendation of any security strategy or chart type. Schwab does not recommend the use of technical analysis as a sole means of investment research. The paper money application is for educational purposes only. We'll be using the Thinkorswim desktop software today, but the strategies I talk about can be done on any, you can do it on Thinkorswim web if you want, or the schwab.com website if you want, but what I'm using is a Thinkorswim desktop platform. All investing involves risk, including risk of loss. And past performance of any security or strategy does not guarantee future results of success. And stop orders. There's no guarantee in execution that a stop order will be at or near the stop price. So having said that, let me head on over to the Thinkorswim platform. And so I want to talk today to you about protective puts. And then I want to talk about different examples there on those. When we're doing options, let me just kind of mention this here real quick. There's kind of three main purposes for options. We kind of concentrate on this class more than anything. And that was supposed to be a little drawing tool. We'll try that again. Speculation. Okay. We think a stock or speculation may go up or down, and we speculate on it by buying a call or put in this class. Speculation was one reason for options. Another, which we don't really talk about in this class, is income. You can use options for income. That's more short option strategies. So you can do that. In fact, I think, if I'm not mistaken, Connie teaches a short verticals class on Thursdays at 2 o'clock. Correct me if I'm wrong, Connie, on that, but that's an approach to gaining income with options. But there's a third class of reason why we may do options, and that is to hedge. And that's what we're going to focus on today. It's probably not going to be the main focus of most weeks in this class, but I think it is an important aspect of options trading. There's pros and cons with it, just like any other strategy, but that's what we're going to talk about today. All right, so there is that. When you talk about hedging, there's different possible ways of hedging, but I think the most common type of hedge is what we're going to talk about today, and that is using a protective put to hedge. So this is not just done by individual investors like you and me. It is done by institutions as well. They will buy protective puts, sometimes on individual positions, but they use index options too as well. And by the way, index options is a class that we have each week, trading index options. It occurs right before this class. So it's recorded though, so you don't have to wait a whole week to get to that one. But there you go. In fact, while I'm on the topic real quick, before I start getting into these, well, you know what? Let's go on. Let's head forth. I don't want to just distract us from where we're at, and I'll get to that later. So when would you hedge is a question. When would you hedge? When do you guys consider hedging? If you'd like, type that in the chat. There's about a little delay between, a 30-second delay maybe between when you type in the chat and when I see it. So I'll let you type that in. What are reasons you may hedge your portfolio? And one thing I want to just make clear as I talk about this, as we talk about hedging positions or portfolio, is this is not a recommendation this isn't a recommendation of any strategy. Furthermore, it's not a recommendation that you do it on every time. You know, for example, Harlot 3000 said earnings, okay, may hedge before earnings. And that's absolutely what I was kind of expecting that people would say, earnings. So you may, on a particular time, hedge before an earnings. It doesn't mean that you should hedge before every earnings. There's pros and cons, as I mentioned. AJ says, I don't hedge. I'm just taking the price loss. And that's okay. There may be times there's something to be said for that, because hedging, there is a cost to hedging. There's a cost to these protective puts. So it's something you'll have to decide on that. Randy says, and anticipate a drop in price. Now remember, there's always, your first go-to thing may be, if you're worried about a drop in prices, just getting out of the stock you're in, if we're talking about hedging a stock here, okay? Or you can look at the whole market. Mike says, when the whole market is high, market's a little frothy, I'm a little worried about my portfolio, I may put in a hedge. So those are all great reasons. Let me just throw in maybe a couple more. Economic events that come out. When you're worried about economic events, sometimes I've heard people talk about, sometimes Congress will have these debt ceiling debates and whether to raise the debt ceiling limit. Well, that's the reason sometimes people will do it, or other economic events, elections or whatever. They're worried about the result of an election, that they'll do it, they'll hedge then. So basically, whenever you're worried that there's a higher than normal risk for that market drop, or the stock drop, that may be when you consider a hedge. So those uncertain situations there. Now, I mentioned a couple things here. Number one, if you're buying a protective put as a hedge, it's costing you money. Let's just look. I have Microsoft up. Here's my Microsoft chart. I'm going to pull up Microsoft, and it doesn't matter what day we're looking at. I'll go out 50 days here, 52 days. Okay. And let's say I want to throw in a hedge here. Let me just get rid of this, and I'm looking at a delta. I'm going to go here, and I'm going to look at the 430, and I'll talk about that 430 in just a minute. But how much would it cost? Well, in this case, now, admittedly, Microsoft is an expensive stock. It's a $445 stock. But a put contract, a single put contract at the 430 strike, that's going to cost me $875. There's no guarantee you're going to get that back. Because, number one, if you buy a put, you have time decay working against you. That's what we call a negative theta trade. Time decay works against you on these long option strategies. That's what all we do in this class are long option strategies. So in this class, we're always doing negative theta trades. I wish it weren't the case, but there's pros and cons to it. Obviously, I wish ideally the time decay would work for us, yet we could still get the price movement that we want. But one of the prices you pay, so to speak, of the having a trade that has the characteristics that we're going to talk about here in a sec is, unfortunately, time decay is not going to work. It works against you on that. You could lose this whole amount here, even if the stock, if the stock goes up, we could lose that whole amount, $875. We could lose the whole amount if the stock goes sideways. I mean, theoretically, if the stock goes down, you could lose it. But in fact, at expiration, this is out of the money. This would be valued at zero at expiration if it's out of the money. There'd be no intrinsic value on that, okay? Because the stock right now is $445. So there's pros and cons to it. And that time decay can kind of eat away at it there. So if it's not helping you out, it's going to work against you. Let me give you an example, case study here. Look at American Express. Look at this position I have right here. I have 100 shares of American Express in this paper money portfolio. Look at what's happened on. American Express has been doing great. The stock's been going up and up and up. I have a put on here as a hedge. Now, it's about to expire in 3 days. I need to do something with that. But what has this put done for me? It's just caused me heartache. I guess maybe I've slept more, maybe you sleep better at night or whatever. But this was protection that I actually didn't need. In hindsight, I didn't know at the time I wasn't going to need the protection. But you can see that substantially eats in to any profits I have because American Express has done very well. Okay. Truth be told, this was actually part of a synthetic strategy, but I just removed the call portion of that just to kind of show you what that would do on that. So, so when you're doing a hedge, just remember why you're doing it. And one of the downsides of it is it can eat into your gains. Now, that's all the bad stuff. Let's talk about some of the good stuff here as to why we may hedge and whatnot. I'm going to stick with, let's just look at this option chain here. Okay, and the question is, what contract should I buy? You have different months and you have different strike prices. By the way, we have a survey link in the chat. We always appreciate your feedback in this class. Okay. So first of all, you want to buy the protection for the duration of the time you think. So for example, if I'm hedging for an earnings date, well, when's our earnings date on this? It's just a couple days away, I think, right? This is on the, come on, it's kind of flashing super quick. I can't even see it. The 29th, okay? What's today? Today's 28th. It's tomorrow. Earnings is tomorrow on Microsoft. There would be no point in this for me to go out and buy. I don't need to buy a month's worth of time because you're paying more for the contract to hedge an option for a day or two, okay? So you don't need to buy the extra time there on that. Similarly, let's say there's a economic event that I'm concerned about in, it could happen anytime in the next, month, or, tensions have heightened in the Middle East or something like that scenario. And you think they're going to be hot for the next, little while. Well, I may buy a month or two of protection, but I don't need to buy 143 days or 100 days of protection. So that's the expiration date we're going to look at here on this. Furthermore, what you can do is, in terms of strike prices, one thing you can use is delta as a guide. And if we look at delta tells you how much that option is going to move in relationship to a move in the underlying stock price. If I own 100 shares of Microsoft, how much Microsoft is that? That's $44,000 worth of Microsoft, okay? So if that's a lot of Microsoft stock, if I were to own 100 shares of that. If I were to hedge that, well, let's say I were to go out to the 30-ish delta, okay? 30-ish delta, that means $1 move in Microsoft would mean about a 31-cent impact on this option contract. Okay, so from about $5 to about $4.70 or so. That's expected. It's not a guarantee of exactly what it's going to move, but that's what's telling you the kind of move. How much could I move totally if I buy? How much can I lose totally on this? I could lose the whole thing. Now, if I do it out of the money, and the stock stays where it's at over earnings, say, I'm probably going to lose money. Okay, I'm probably going to lose money. If the stock goes down a little bit, I'm probably going to lose money. But if I do this 435 strike, let me just circle that. If I do this 435 strike and the stock drops substantially, I can potentially gain money. And as the stock goes down further and further, what happens is that delta goes up, okay, in terms of absolute value, at least on that delta. In other words, at the money contracts are roughly about 50, okay? At the money contracts are roughly 50. So if Microsoft were to go down from 446 down to 435, my delta here would probably go from about 31 to roughly, and this is roughly, 50, or negative 50 to be precise on that. Okay. What if it were to go in the money $10? So when instead of going down to 435, it went down to 425. Well, what's our delta on our $10 in the money contracts right now? Well, $10 in the money, if I were to go for $10, that's about a 63 delta. So if it went down there, it'd be about a 63 delta. So do you see how delta goes up the more the stock goes down? There is more protection in the strategy the more it goes against you. And there's pros and cons to that. One advantage of this is, well, obviously, this is meant to protect against a very bad move in Microsoft. It's not meant to protect against a small move down in Microsoft. But if we have a very large move down, we're getting more and more protection. Now, is it protecting us dollar for dollar? Do we make up all of our gains? No, we don't. And the reason typically we're not going to buy a protective put with a delta of 1 or a deep in the money protective put is cost. Look, if I think Microsoft is going down and I'm pretty confident of it and I don't want to take any risk, I may just sell out of Microsoft entirely of this stock. But, and I'm just using Microsoft as an example stock here. There's nothing specific. I'm just using this as an example. But if my thought is, I kind of just want a little protection here in case it goes significantly against me, this is a lower cost way of doing it by going out of the money to something in the 30-ish delta. If I want a little more protection, maybe I move something closer to the 40 delta. A little less protection, but cheaper, something maybe closer to that 20 delta. If I go to that 20 delta, it's not going to help me much unless I get a very large move in Microsoft down. But if that's what I'm trying to protect against, that may make sense. Any questions on that? Let me know. So when I'm kind of giving you some guidelines on this, these are just kind of more kind of common things that I see a lot of traders do. It's not a recommendation. It's also not something you can't tweak. Just realize the pros and cons of going to further out of the money versus closer to the at the money contracts. Okay, so that's how we're gonna do this. And so this is what we call a positive gamma trade when it's a long option. All that means is the delta works in our favor if it goes against us. And the good thing is if it kind of moves against us a little bit, then our delta is pretty low because it's out of the money. So if the stock goes up a little bit, we may be able to salvage a little bit out of this just because a small move, that delta is not going to be a significant impact. Okay, so Sharon says, you want to buy the 7th of February expiration. I would consider the 7th. It probably doesn't. So this is a good question. I'm just showing this expiration because I wanted to model, we don't need to buy a lot of extra time on this. You may consider, in this case, doing the 7th of February. It's going to cost a little bit more, right? Going out to February 7th. And also, one advantage of the 7th of February expiration is the time decay on the January 31st expiration is basically going to completely wipe out the trade probably if it's out of the money at expiration. The extrinsic value is probably going to go to pretty much zero because we're also going to get a drop in that implied volatility to help with that implied volatility drop. That February 7th one may make good sense there in this case there, Sharon. So because of that implied volatility, I'm not going to disagree with you on that. I think that February 7th may make sense. I just wanted to kind of illustrate that we want to go past. You don't need to buy a lot of extra time here. Extra week may make sense there, especially with that implied volatility change there. Okay, good question. Ricebird says, so when you have a stock and buy the put, can you exercise that to cover the shares you own? So in general, we're not talking about exercising options in this class. in general, we're going to look to sell that contract as soon as the event, the uncertain event, is past. Now, there's a reason for that, Ricebird. That's a good question. Why don't we exercise? Well, once you get to expiration, there's not going to be as big a difference between exercising and just letting the thing, uh, go all the way to expiration. Before expiration, one reason why traders don't exercise contracts is essentially you lose out on the extrinsic value of the contract. Okay, let's just take an example here. I'll go to this one where we're at. And let's say we had a $450 contract. So we're just in the money a little bit. What would this $450 contract give me the right to? Well, it would let me sell this stock for $450. It's a put contract, remember. I could sell that stock for $450. Well, right now the stock's at $446, okay? So that sounds like a great deal. $446. Instead of $446, I get to sell for $450. But keep in mind, if instead of exercising that, I were just to take that $446 stock and sell the option, which is worth $11, I'm rounding here, the actual net total is $457. So it's not in my benefit typically to exercise that contract early. All right? That's why. I don't have time to go into more math on that right now, I think, but that's the gist of it, Ricebird, is usually it doesn't benefit us on that. Now, what about just letting it go to expiry and not selling out of this? You can do that, and once you get, if the stock goes in the money a ways and we're right at expiration, you can choose that if you want to sell the stock. Maybe you don't want to sell the stock. Maybe you just you're long-term bullish on the stock and you want to continue to hold that stock. Then you don't want to let it go because you'll have an auto exercise on that if you just don't do anything there. So that's why. All right, let's go. These are great questions. Bob said, with time left before expiration, you're better off selling the option rather than exercising. Yes, that's what I was trying to get at there. Sia says, what's the best time frame in expiry for going long? It depends on the type of trade. Okay, it all depends on the type of trade. For this particular type of trade, and we'll move on after this. For this particular type of trade, we're going to buy just a little bit past what the uncertain event was. In this case, it was an earnings event, but you don't need to buy extra time. But if you're going long in general, it just depends on the type of trade, whether it's trend trade or long trade. But here we're just talking about hedge for a particular event. So let's go and let's look at, let me go to my portfolio here. Let's move on. So I have some stock here in this portfolio. We just showed you American Express. By the way, there's a survey link in the chat. American Express, we just showed you some of the perils, if you will, of hedging. But I have some other stocks here, and I can tell right here that I have earnings coming up on them. I have CNP coming up with earnings, and I actually have a stop order on CNP. Let's throw in a hedge here, though, okay? Let's put CNP in here and just take a look at this. This is our sample Centerpoint Energy trade. I have a stop down here. Now, of course, you've heard me say a million times, stops don't guarantee the execution price. So if let's say we have a earnings that goes south on us here, it's not showing on the graph right now. Let me just look real quick and see when our earnings is on CNP. Earnings is on February 20th. Yeah. So we still got a little ways here before earnings on this. I'm not sure why. Surprised that's showing that this early. That's a month. I guess it's less than a month. We're at the end of January. It's less than a month away. In any case, But my point being, if we do have earnings, could this go below? Right now it's at 32.20. Could it go below? Does that mean we're going to get out at 30, wherever my stop is, $30.50? No, this could gap way down. Look at NVIDIA yesterday. And that NVIDIA yesterday was an example of some unexpected news event that we couldn't have planned on. I mean, I guess by definition, that's unexpected, right? Earnings is one that we can plan on a little bit more here. So if I'm worried about this going forward, I could wait. If it's just particularly earnings, I could wait a little bit longer, but I could buy this. I could buy some protection on this here. And I'm probably going to go, expiration is, earnings is the 20th. So this is technically after earnings. The implied volatility drop is not nearly as big here as it was on our Microsoft trade. So it's not going to hurt me as much to go here on this one as that Microsoft. I'm going to look around that 30 delta, and 27, we'll call that close enough. Got a bid-ask spread that's pretty large. This is a contract that is, these contracts aren't the most liquid contracts. 10-cent bid-ask spread on an option that is, it just changed prices on me. 25 to 15. That's not very, sorry, I was looking at the wrong one. 35.40. Now it's a 5-cent there. But we could always buy that put. This is a long put now. And my mid price is 38. I could see if I get filled at 38, but it's less likely. And so I'm just going to throw this on here. I'm going to confirm and send. And I'm going to put this in my long stock section. That should match it up here. We filled, and CNP, now I have this put here on this long put to try and help protect me on that. So that's an example. Maybe a better example, let's look at CVX. We have earnings on CVX on the 31st. That's just a few days away. Okay, so Chevron, we have earnings on the 31st. I have no stop order on this right now. You can see the earnings coming up here. These are going to be more liquid options. I'm liking this one a little better from that standpoint. And I'm going to go to the trade tab. And let's just kind of look here for a sec. Earnings are on the 31st. So I'll go out past that. We'll go out to because that's the expiration date. We'll go here. I'm going to go to that delta again of around 30, but I want to show you something. Let me go to the Theo Price tool. And I'm just going to reset it. This Theo Price tool, you can just select it right up here. We can see what kind of move the option may have if the stock does something. So let's say the stock goes down, I don't know, 10% over earnings, okay? 10% over earnings. So what I'm going to do is I'm going to go here, and I'm going to say stock price adjust. I'm going to turn this to percentage, and I'm going to put in -10 here. And I'm going to say, well, my implied volatility is probably going to drop over earnings. Let me just look real quick and see what our implied volatilities are as we go out. 25. So the implied volatilities aren't hugely skewed, so it may go down just a few percent. So in volatility just, I'm going to go to we'll say -3%. Okay, drop on earnings. And I'm going to say we're in this a week. I think I clicked on the wrong date here. Hold on one quick sec. We said earnings were on the 31st of January. And okay, there we go. So now we're going to February 7th. Should not be looking at that. We're going to February 7th. And let's look at our, just look at my delta here. I was going to do the 30 delta. 30 delta, we're going to do this one right here. So look at the Theo price on this. If the stock were to drop by 10%, and admittedly, that's probably a bigger drop than what we're going to see. But what happens to the option? The option goes from about 146 up to 12 bucks on that. Now, maybe 10% is too big a drop to consider. Well, let's look at a 5% drop. Okay, let's look at a 5% drop on this. Okay. Again, 3% drop in implied volatility. A 5% drop, 30 delta, options going from $144 is what the cost is for one contract to approximately, again, it's a theoretical price, $485. So what's our benefit on the option contract? The option contract goes up from there to there. That's what? $340. We benefit to the effect of $340 on the option there on that. What happens on the stock? Well, we're losing 5% on the stock price. I said, so I'm going to go 0.95 on my calculator times the current stock price, 155.4 is equal to 147.63. That is a $7.80 drop in the stock price. And since we're talking about 100 shares here, basically we're losing $780 on the stock, but we're gaining not quite half of that back in the option price. So this is a hedge. It's not complete protection, but it helps against some drops. Now, we showed the difference between, this was the 5% drop, where, yes, that was a huge, 5% drop is a big drop, but not unrealistic for earnings. The 10% drop, we saw a much bigger move. Why? Because the delta kicks up there, remember, the more that stock drops down. Okay? So I'm trying to remember what it was, I can't remember what the price was on the Theo price here on this, but instead of a $340 gain on the option, if we went down 10%, it was over $1,000 gain on the option there. Okay, now we're losing a lot in the stock. A 10% gain is a $1,500, 10% loss on the stock. That's a $1,550, I'm rounding a little bit, loss on the stock. But on our option, we're using this option here, it is a, what we say, about $1,100 gain. So we're down $450 or whatever net, but losing $450 is a lot nicer than losing $1,500. Okay, so that's the purpose of it. Now that's the good scenario. It's not a good scenario because the stock goes down. But what if the stock does nothing? Here's the problem. This is where the negative theta is. If the stock does nothing, I'm just saying no change in stock price, look what happens to that option. The option, which we started out worth $140, is basically nothing at that point. Okay. Basically nothing on that. All right. So there's that. Greg said market maker move is showing 347 right up there. Yeah. Now we're on February 7th, which is showing a move of $5.50 between now and then. So there is a little difference there on that. Remember, and you're only going to see that market maker move here for the first, if this occurs for the first, not on the subsequent expiration dates on that. So, yep. So you can kind of judge how big it is. That's just kind of illustrating protective puts there. So let's do that trade here just as an example. We'll throw on that protective put there, and then we'll look to manage it. Typically, once we get past the event in question, the event of uncertainty, then we'll exit that trade there. I'm going to confirm and send this, and we'll put this in our long stock, send. We have a couple protective puts here. Now, there's one other thing I want to mention here today, and that is this. That's individual stocks. What if I want to protect a whole portfolio? Can I protect a whole portfolio? And the answer is yes, you can look to protect a portfolio. Okay. There are different ways. One is to use index options. I already mentioned index options. In fact, I did a class on hedging your portfolio with index options. For those of you who are watching live and can see the chat, I just put a link in the chat to that class. For those of you watching on a recording and can't see the chat, what you need to do is just go to the Trader Talks channel, Trader Talks Schwab channel, go to the Managing an Options Portfolio playlist, not this class, the Managing an Options Portfolio playlist, and look at January 8th. And I have a class on using index options to hedge the whole shebang, not an individual stock. And so, maybe before earnings season or maybe before whatever, you can use index options to try to help protect your whole portfolio. Again, you have the same issues with those index options as you do individual stocks. Time decay still works against you, right? If the portfolio goes up, that's great, but you're not making up as much as you would as if you picked as if you didn't do that hedge in the first place. Now, Chris said, this hedging technique seems to make more sense for someone who's been in the position profitably for some time than for a shorter term trader who probably got in closer to the current price. I would say more often than not, people are reluctant to just sell out of a position if they've been in it for a while. Maybe they're a long-term trader and they just want to protect for a little bit. Whereas if you're a shorter term trader, you're probably more likely just to say, I'm just going to get out of this position in front of earnings. Long-term trades, look, maybe you don't want to, maybe there's a tax reason you don't want to do it, whatever. This may make more sense in those cases. So I think, I think there's probably some truth, Chris, to that, but you could use this for shorter term as well. It's up to, it just depends on individual circumstances. But if you're doing let's say, you're buying a stock and you're planning on being in it for 2 or 3 weeks and you're worried about earnings, just don't do that stock right in front of earnings in that case. But if you're a longer term trader, you can't avoid it. Okay? I'm hoping that's making sense. Now, everyone, thank you very much for joining me today. Make sure, if you want to learn about hedging your whole portfolio, number one, one approach people do in addition to index options is our ETFs, which we talk about in our trading ETFs class, which occur on Mondays. Connie teaches that class, wonderful class, 4 o'clock Eastern time on Mondays. That one is live only, it's not recorded, so make sure you check that out. Or check out the link that I posted in the chat for the recording on hedging a whole portfolio class. Thank you all for joining me today. Remember, there was a survey link in the chat. If you would fill that out, we'd appreciate it. And coming up next, we have Getting Started with Technical Analysis. So make sure you check that out. Make sure you subscribe and like. And thank you, Connie. And thanks to each of you. Have a great rest of the day, everybody. Bye-bye.